If you've just started investing or trading in cryptocurrencies, then no doubt you've heard futures mentioned at least once or twice. So what are futures and are they important? And if they are, what are the data points that you should be aware of and how can you use them to your advantage? Hi everyone, I'm Paul, and in today's video we're going to do a deep dive into futures. Futures are an integral part of the crypto markets and they're here to stay. So understanding how they work, who uses them and why is going to help you to navigate the crypto markets and make better investment decisions. And if you stick around until the end of the video, I'm going to introduce you to some free resources, show you how to use them and give you that extra edge in your crypto trading. So let's jump in. To start off, let's talk about spot trading. So spot trading is probably what you've already done. So if you've already bought Bitcoin or Ethereum or other altcoins on an exchange, that means you've traded spot. So spot trading is just the technical term people use in the industry for buying the physical asset for immediate settlement. And all settlement means is that you're exchanging base currency or fiat for that particular coin and you take ownership of that right away. And so once you have ownership, that means that you can either choose to sell that coin at a particular future date, you can transfer it to a wallet or to a different exchange or to a DeFi platform. Once you have ownership, it's completely up to you. Futures, on the other hand, are a derivative product. And derivatives basically create an obligation between two parties to exchange an asset at a particular price at a particular point in time. A derivative product's price is primarily determined by the price of the underlying asset. Now, there's other factors that influence price in terms of how far expiration is and so on, but the price of the underlying asset is the primary driver of the price of the derivative. The advantage of futures contracts is that they can be standardized. So that means that when you're trading a particular futures contract, you know exactly what that entails. So what the underlying asset is, how much of it, the quality, all of those sorts of things are included in the contract. And then by trading it through an exchange, it means that when you exchange those contracts or you trade those contracts, you're trading like for like. And the other advantage of trading through an exchange is that you then have a clearinghouse on the other side and they manage the counterparty risk. So when two parties trade against each other, they're effectively exchanging a contract and the clearinghouse manages the risk between those two parties. When you look at futures contracts on an exchange, they're generally grouped by expiration, and expiration just means when that contract will expire. So on most exchanges, they're generally monthly, quarterly, but you can also have annually. It just depends on the particular underlying asset and the exchange that's being traded on. Now, futures have been around for a really long time, and you can trade futures on a whole number of assets. So that can be precious metals, that can be commodities like wheat, orange juice, oil, stocks. Pretty much any asset you can imagine has got a futures contract that trades over the top of it. So if you've heard about derivatives, you may have already heard about options or been exposed to options before. So options and futures are fairly similar. They are both derivatives and they often cover some of the same underlying assets, but they are a little bit different. For futures, the buyer of a futures contract is obligated to take assignment at expiration. And so assignment just means that they take possession of the underlying asset or a cash equivalent at the time of expiration on that contract. However, this doesn't mean that when you buy a futures contract that you're obligated to wait until expiration. If you want to close out that position, and even as a seller of a futures contract, you can choose to do that at any time up to expiration. So if you buy a contract, you can simply sell that contract before expiration, and that of course nullifies your position. Equally, if you had already sold a futures contract, you just need to buy it back before expiration. So why would you use futures? There's two main reasons why people use futures, and that's firstly to speculate, and then the second is to hedge. So as an investor or a trader or a speculator, you might have a particular view on the price of an asset, and so you can use futures then to make effectively a bet on the direction of that asset. So if you thought that asset was going to go up, you would buy a future, and if you thought it was going to go down, then you would sell a future. Businesses also use futures, but the way businesses use futures is as a hedge. And so this occurs when you want to fix the price of an asset at a future date. So for example, if you were a corn farmer and you currently have a crop and that crop may be due to be harvested, say in the next sort of 3 or 6 months, you may think that the price of corn right now is good and you might want to lock that price in for when your harvest is due. So you could use the future to lock in the price of that asset, so when it comes time to harvest and you go to then sell your corn, you've locked in that price in advance. Investors can also use futures as a way of hedging. So if you're an investor and you have an exposure in, say, stocks or gold, and you are concerned that the value of those assets was going to go down, like the market would fall, then you can use futures to hedge those assets. So in those examples, you would sell futures, so you would lock in the price of those particular assets at the current price, and if the market fell, then you would then be able to buy those futures back at a later date and you would make a profit. So you would still lose value on your spot assets, so either your stocks or your gold, but you would have made money on your futures, and you can use the money made on those futures to offset the losses on your spot assets. So the reason why people use futures is you only need a fraction of the capital to get the same amount of exposure. So each contract represents a certain amount of exposure, and you only need to put up a certain amount of capital or collateral to get exposure to a much larger amount of that asset. And so this is what's called leverage, and this is the primary advantage of using futures, is it's very capital efficient. So whilst using futures offers the benefit of leveraged, we have to manage that risk of that exposure. So we have to manage that leverage in a specific way. And the way they do that in futures is through what's called margins. So the whole idea of margins or margining is to ensure that people who are trading in futures can manage their future obligations if price moves against them. So when a position's opened, there's what's called an initial margin. So that's the initial amount of margin that has to be put up to enable that trade to be facilitated. And then as time goes by, there's what's called a maintenance margin. So in most markets, that maintenance margin is calculated and adjusted for every single day. So most derivative products work in this way. And for futures, you will have an initial margin and a maintenance margin. And the two of those make up your total margin obligation. So these margin requirements are generally mandated by the exchange or the clearinghouse that you're using to trade those futures. But it's not uncommon that the broker that you're using to trade on that exchange will mandate that you have to have margin in addition to those minimum margin requirements that are mandated by either the exchange or the clearinghouse. So it's not uncommon that you will have different margin requirements between brokers, and they will have different methods for calculating what those margin requirements are. So depending on the asset, you can meet your total margin obligation through the cash or collateral. Now, cash is taken at 100% of its value, but collateral is generally given a haircut. So all that means is it's discounted, so you don't get the full value of your collateral to offset any margin requirements. It's also quite common that you can also use portfolio margining. So that means that you might have a number of different assets and you can effectively use that collateral across all of your margin exposure. So looking now at Bitcoin futures more specifically. Now, Bitcoin futures are quite different to traditional futures because Bitcoin itself is not a regulated asset. It's not seen as a financial product by most regulators around the world. And so it's quite unique because you have two exchanges. You have the CME, which is a traditional regulated futures exchange, and then you have cryptocurrency exchange offering futures on Bitcoin as well. And so this is a little bit unusual and kind of unique to Bitcoin. And so the CME, that's the Chicago Mercantile Exchange Group, is a traditional futures exchange. They offer Bitcoin futures and micro Bitcoin futures. So the advantage of the CME is that they're a regulated exchange, which means that financial institutions, traditional financial institutions, can use them, and also opens up access to other investors through brokers that use the CME as their futures exchange. Being a regulated exchange, it has the benefits of a central clearinghouse, which removes a lot of the counterparty risk. They use monthly expiration, and in terms of a spot price, the CME uses what's called the BRR, or the Bitcoin reference rate, which is essentially the amalgamation of the spot rate across a number of cryptocurrency exchanges. And on the other side, we have our cryptocurrency exchanges, and they're quite often the same exchanges that you use to buy your spot cryptocurrencies. And on those exchanges, you can trade Bitcoin futures, and you can also trade perpetual contracts or perpetual swaps. And so the contract specifications and expirations can vary between each of the exchanges. And so why would you use Bitcoin futures? Well, similar to traditional futures, if you are going to speculate on the price of Bitcoin, so if you're going to bet on it either going up or going down, then you can use futures to give yourself that exposure. And similar to traditional futures, except in this case we're talking about miners, they might want to hedge the price of future block rewards that they're going to receive. And equally, as an investor in Bitcoin, if you had a particularly large holding, you can use futures to hedge the risk of that portfolio against a fall in the Bitcoin price. And just like in traditional futures, Bitcoin futures give you access to leverage. So that means that you can gain a much larger exposure than you otherwise would be able to with a smaller amount of capital. And again, just like in traditional futures, you use collateral to meet your margin obligations. And in this case, that's either with Bitcoin or with stable coins. One of the unique characteristics of Bitcoin futures is what's called perpetual contracts or perpetual swaps. You'll hear them often called perpetual futures. The key difference between perpetual contracts and traditional futures contracts is that there's no expiration. So that means that it's effectively an open-ended futures contract. So in traditional futures, when you're about to have a contract expire, you then need to roll that position to the next month or the next few months out, and they call that rolling. So the advantage of perpetual contracts is that you don't need to do that. You can effectively set a long or a short position, and you can leave that open for as long as you're able to fund it. However, because there's no expiration, the price of the perpetual contract needs to be pegged to Bitcoin in some way, and this is done through the funding rate. The funding rate's a mechanism which balances short and long positions by either incentivizing or disincentivizing traders. And so what this means is that traders either pay or receive the funding rate depending on if the price of the perpetual contract or the perpetual swap is above or below the current spot price of Bitcoin. And how much that trader receives is dependent upon the size of their position. So to give some examples, if the price of the perpetual contract is above the spot price of Bitcoin, that means that there's a positive funding rate. And this means that traders who hold long positions have to pay a fee, the funding rate, to traders who hold short positions. And the opposite's also true. If the price of the perpetual contract is below the spot price of Bitcoin, that means that there's a negative funding rate. And so when there's a negative funding rate, that means that traders who hold short positions have to pay the funding rate or a fee to the holders of long positions. So that might be a little bit confusing, but at the end of the video, I'm going to go through the funding rate and show you some charts and explain how you can use that in your trading and investment decision. So just like traditional futures, Bitcoin uses an initial margin and a maintenance margin to make up a total margin requirement. The collateral that can be used to offset this total margin requirement can either be Bitcoin or stable coins like USDT. So what happens when the value of a trader's positions fall below their margin requirement? This is what's called a forced liquidation. And so when a trader is forced liquidated, the exchange steps in and takes over their positions through the insurance fund. So crypto exchanges don't have a central clearinghouse. And so what they have instead is an insurance fund. And the insurance fund is created through fees that are charged to liquidated traders and any profits that they made through the liquidation of those positions. The exchanges also use what's called auto deleveraging or ADL, which protects other traders from margin call losses and from counterparty risk. The exchanges really try to avoid using auto deleveraging, and it tends to be a tool that they only use when the markets are particularly volatile or illiquid. So that was a lot of information, and hopefully it wasn't all too technical. So this leads us to the question of why is this all important? Futures markets give us a really good insight into market sentiment, and it's very common for futures markets to be a leading indicator of market reversals. The other thing that happens in markets that have futures over the underlying asset is that you have liquidity events, which can often result in really extreme moves. So understanding what futures traders are doing means that we can position ourselves to take advantage of those potential liquidity events. So these are the three resources that I use to look at a lot of the futures information, and they're all free. So I'll link them in the description so you can use them. They all provide similar data, slightly different, and I'll go through some of those differences. So try them all out and just pick one that you like the best. So in this next part of the video, I'm going to run through some of those different data points and explain how you can use them in your trading and investment decisions. So I'm going to start with Crytpoquant, and this is a really great resource. You can sign up for a free account and then you can create your own dashboard, which is what's sitting in the background here. And there's a whole bunch of information here, not just on futures, but a whole bunch of on-chain metrics which you can use in your trading and in your investment decisions. But for now, we'll just look specifically at some information around futures, and I'll talk about how you can use that in helping you to make some of your trading and investment decisions. So once you've created your account on Crytpoquant, you'll be able to go into their charts and you'll be able to start pulling down information. So if you navigate over to derivatives, that'll give you access to a whole bunch of different charts. And so I'll just run through a couple of the ones that I think are worth looking at and just explain how you can use those in your trading. So the first chart we'll look at is open interest. And open interest just talks about the number of open contracts, so that's both long and short positions at any given period of time. So you can see here, this is just mapping the open interest against the Bitcoin price. And you can see how this has grown over time, and you can see generally around when the market is peaking, that's when open interest is at its highest. And what we'll often see, and this coincides with what's called deleveraging events. So when the market falls, so you can see here when the market fell mid last year, you have these big deleveraging events where the open interest drops, and again up here, and then again after the all-time high in November last year, you can see we had these big deleveraging events, and this is this one that was on the 4th of December. And so this happens after you have significant market moves, so either up or down, you'll often have a deleveraging event which is attributed to that market move. Now the next chart we're going to look at is the funding rate. Now I think this is probably one of the most valuable charts that you can look at, and it's going to give you a lot of insight into what's happening in the market at any given time. And so you remember from the video we talked about the funding rate, and the funding rate is used in perpetual contracts. And so because perpetual contracts don't have an expiration date, they need a mechanism to anchor themselves to the price of Bitcoin. And this is done through the funding rate. And so remember, the funding rate is positive when the price of the perpetual contract is above the spot price, and it's negative when the perpetual contract is below the spot price. And that's demonstrated in this chart here. So when this line here, you have these green bars, that's when the funding rate is positive, and when it's red, that's when the funding rate is negative. And what you can see from this chart, even though we're quite zoomed out, is that you have these big spikes in the funding rate, generally around when you have the peaks or troughs in the market. So you can see at these times here, when we were reaching all-time highs at this particular period in the market, the funding rate was extremely positive. And you can see like down here, when we had this big market pullback, the funding rate was extremely negative. And so the funding rate can be a really good way of anticipating future market reversals. And so what you can see here is that the funding rate went particularly negative as the price of Bitcoin was falling. And so this is often seen as an indicator that the market is about to reverse, because what's very common in leverage trading is that at extreme points in the market, as I said, the futures market can be a way of having insight into sentiment, into market sentiment. And so you can see here as the market's fallen, and at this point in the market, it's already pulled back 50% from all-time highs. So the sentiment in the market is extremely bearish. And so what we have here is an indication with the negative funding rate that lots of traders are taking leverage short positions at this extreme low point in the market. And this is often coincides with a reversal and then an associated liquidation event, which means you then get, in this case, what we call a short squeeze. And so what we can do as investors and traders is we can be monitoring the funding rate. And so particularly at times when the market has already fallen quite a lot and we're trying to figure out if the market's reached a bottom or is near the bottom of that particular move, we can be observing the funding rate. And when it goes extremely negative, that means that there's increasing pressure, more traders taking short positions at this extreme point in the market. And of course, the danger of that is you have people who are leveraged at this price, and any small movement upwards will create those forced liquidation events we talked about earlier in the video. And so when we have liquidation events, we can actually monitor that through these charts as well. So for example, if we wanted to look at long liquidation, so if the market had fallen, you would obviously have leverage traders who are long getting liquidated, and we can look at that through this long liquidations chart. So what we have here is the same time period as long liquidation. So you can see this is the price of Bitcoin here, and the green bars are the liquidation of long positions. So these are the liquidation of leveraged long positions. And so you can see here as the prices pull back, it's obviously already been pulling back over this period, and it just gets to the point where it's pulled back too far and these leveraged long traders start getting liquidated. And you need to remember, because they're leveraged long, to close out their positions, they need to sell. And so what you get is this kind of cascade effect where the market's already falling, then you get leverage traders having to sell. So you get this kind of acceleration occur. And you can see this happen here. So we keep falling. You have often what happens is leverage traders will revenge trade. They will have lost here and then they go long again. So they keep going long, and as the market keeps falling, they keep getting liquidated, and you just get this continuous sort of downward spiral. And you can see here, as we've reached this sort of peak low down here at around 35,000, you get this, clustering of liquidations, and that's sort of the final capitulation, if you like. And so we can also look at short liquidations on the chart as well. So if you remember from the funding rate chart we looked at, we'll just quickly go back, we had these clustering of negative funding rates as the market came down to this lower point here. And then what we see here on the short liquidation chart is that we then start to have all of these liquidation of short positions. So you can see market goes flat here, and then as it starts to come up, obviously the market's now moving against those short positions, and you get these short liquidations. So again, similar to what happens when you have long positions getting liquidated, they have to go into the market and they have to close out their positions, but because they're short, they have to buy. So again, you get this like melt up effect. They call that a short squeeze. Now, one of the other platforms that I had in the description is Laevitas. I hope that's how you pronounce it. And again, this is a free account. You can create your account, sign up and create your own dashboard, or just use their information. I don't really bother with a dashboard. I just use their information. And as before, you just come into futures here and just click on these links, and then you can go through and see a number of charts. Now, this is much more derivative specific, where Cryptoquant has information across a bunch of whole other on-chain metrics as well. And this shows you more near-dated information, but goes into a lot more detail and breaks down the exchanges. So that's probably not relevant for most people, but there are a few like bits and pieces in here which I think are helpful. So as before, there's open interest, and as I said, it breaks down by the various exchanges. So if that's interesting to you, that's something that you can dive into in a bit more detail. It also shows the volume, which I think is helpful because it's interesting to know if participation's increasing in futures markets or if it's in a bit of a lull. And then there's this different way of looking at the liquidations as well. So this again breaks it down by exchanges, and you can see where it peaks and troughs. And so we were talking about before where the market has come back from lows, and that's created a whole bunch of short liquidations, and you can see that very clearly on these graphs. And again, there's very similar information, it's just given in a much more granular format, broken down by the various exchanges, and really it just comes down to a personal preference as to which you prefer. I like to use them all just because you don't really know all the data sources, and so it's good to look at them all, and you can kind of pick and choose what you look at. And obviously if they're all showing you the same sort of picture, then you can feel more confident in your decisions. And it just allows you to go into much more detail into some of those various components. So whether that be looking at the funding rate or at liquidations or open interest or volume, you can just go into a lot more detail through Laevitas to look at that. And the last platform we'll look at is Coinalyze. And so this is similar to the Laevitas platform in that it breaks down all the same information that we saw on Cryptoquant, but shows it to you via exchanges. And it's just a slightly different way of looking at the same information. So the reason I like the Coinalyze website is you can look at it on the chart, and the chart actually allows you to break it down into different time frames, and so you can be much more granular than you can on the other platforms. So for example, this is showing a 1 hour time frame, and this is open interest, so this is obviously the number of contracts, and you can see how that's changed over time. And I can then just change this via the drop down to any time period I like. And I can also look at other information like the funding rate or liquidations, and this is where I find it particularly handy. So if we look at the funding rate, so the great thing about Coinalyze is you can see through the funding rate, you can see the margining through stable coins, and you can see the coin margining as well. So that's an additional piece of information you don't get on any of the other platforms. And you can see down here, again, we can change the duration, but this is on an hourly basis, so that's obviously the price of Bitcoin at the moment. And you have here the aggregated funding rate at the different intervals, so each hour. So you can see here the funding rate's gone negative a number of times over this period. And then you've got this predicted funding rate as well, which is obviously predicting where the funding rate might go in the future. So you can see, even though at the moment the current funding rate is positive, the predicted funding rate is negative. And we can see the same thing with liquidation. So again, we have the chart, but the other thing that I think is really handy is not only do we have the breakdown by exchange, but we also have the breakdown in terms of liquidations long and short, and then by the types. Remembering we have both traditional type futures in Bitcoin, and we also have perpetual futures. So we have those perpetual contracts, and you can see the breakdown. And the thing that you'll notice as you look at this data more and more is these perpetual swaps, these perpetual contracts are by far the dominant product that people use when they're trading leverage on Bitcoin. And so it's obviously quite helpful. You can look at, the liquidations by the various exchanges, and it breaks it down by both the shorts and the long liquidations. And then you can look at it at particular intervals down here against the price chart. So you can see here, as the market went up today, you can see that these short liquidations have occurred. So you can see these buybacks will have occurred. And as we talked about in the video, is that as these short liquidations occur, the exchange is having to buy these positions back on market, and that creates this short squeeze, this cascade in price up. And equally on the way down, if we look at this on a daily basis, you can see here when the market pulled back, you get these long liquidations as well. So this information is really helpful, and you can help it a lot in terms of gauging market sentiment, and then helping to understand why the market may be moving in the way it is because of both liquidations and position taking by futures traders. So that was our deep dive on futures. It's quite a lot of technical information, so I hope that was helpful. I think the thing is, you don't have to necessarily understand at a really deep level about how futures work, or about how the liquidations work or margining works or anything like that. But I think understanding what Bitcoin futures are and why people use them is really important, because futures are just such an integral part of modern markets. And so I hope some of the insights I gave you in terms of how I look at those charts and how I use that information is helpful, and you can use that in your trading and investment as you go forward in the markets. If you enjoyed this video, it'd be great if you could like it. That'll help other people to find it. And if you enjoyed this content, it'd be great if you could subscribe to my channel, and I'll see you on the next video.